Hi there, welcome to Kneppy Invest and welcome to the stock of the day. Typically, I choose the stock of the day among a group of companies that have released interesting announcements. And those interesting announcements might have moved the share price of these companies up or down by a significant amount. Unfortunately, December 27, 2024 might be the most boring day in ASX history in terms of announcements. So, not a lot of announcements or companies to choose from in terms of announcements. So, I thought instead, because I do want to do a stock of the day video, I'll choose a company I've been looking at over the past few days in terms of valuation. And the question I do have for myself is IPH, the focus of today's video, good value at current levels? So I thought I'll go through the processes I do in assessing whether a company might be good value or not. So first thing I want to do is just have a look at this company. So IPH is an intellectual property company with offices throughout Southeast Asia. I'm pretty sure they have offices in New Zealand, and I think they've expanded into Canada. Company listed on the ASX back in 2014. And at that point in time, there was actually a few companies or few IP companies that listed, including IPH and another smaller one called Quantum IP. Quantum IP was bought out by IPH about a year ago. In fact, I remember that because I was trading Quantum IP at the time. They released a positive trading update, and then the takeover bid was announced. The share price just popped up. Other than that, that's really all I know about IPH. Listed 2014, intellectual property. And actually, when they did list back in 2014, this was a really good story. I'm pretty sure the share price went on a massive run during the first year of their history on the ASX. And we can confirm that by looking at the chart. So what I'll do is I'll have a look at the chart first, and then we'll have a look or assess whether this company might be good value at current levels. Now, if it is good value at current levels, you would think there should be a support to the share price, because the share price has been a downtrend for about 2 years. Now, this is the weekly chart for IPH, and if we go all the way back to 2014 when they listed, the share price was about $3. And within a year, or maybe 2 years, they listed in the week of 17 November 2014 at about $3. And by the end of 2015, the share price had rallied all the way up to $9.50. So a nice three-bagger over a 1 year period. But when you do have a look at this chart, this weekly chart, a 10-year period, it does not show the characteristics of a high-quality company. So that is one of my questions I have in regards to IPH. Is IPH a high-quality company? This tells me no. Now, this tells me no because share price when they listed $3, share price now $5. Share price has been as high as $9 to $10. It's reached that level or that zone 1, 2, 3, 4 times in the past. But it also has pulled back all the way down to $3, $3.50 back in 2018. So something really bad happened to this company in 2018. And right now, the share price is in a well-defined downtrend and has been a downtrend for about 2 years. Let's confirm that. This is the daily chart. Moved into a downtrend towards the end of 2022, so about 2 years ago. And to be honest with you, there's no reason to get excited about this company, just based off the trend. However, because this company is profitable, pretty sure they're growing as well, eventually there will be some value investors coming in and propping up the share price, maintaining a floor on the share price. I'm not sure we're seeing that just yet. Okay, so that's the chart for IPH. Nothing much to like in terms of trend, but let's have a look at valuation. Is there anything to like about this company when it comes to value? I am traditionally a value investor. So this is something I would do in the past. Now, one of the things that drew me into IPH was not the chart. It was just the P/E ratio. I actually went below 20. And I was thinking that hasn't happened much or all too often for this company. So the first thing I like to do when I'm assessing whether a company might be cheap or not is just to have a look at the P/E ratio history of a company. So let's do that right now. P/E ratio. It's actually fairly to do. This is FinChat, the overview page. I'll briefly go through this fairly quickly. Market cap is 1.4 million, EV or enterprise value 1.8. So they do have a little bit of debt. Shares outstanding 275, revenue 605, And margins, gross margin 64.4, EBITDA margin 29.4, operating margin 21, return on equity 11.9%. I prefer that to be a little bit higher. Return on invested capital 9.3. Those are 5-year averages. I prefer that to be a little bit higher as well. P ratio below 20. Price to book 1.93. Price to free cash flow 11.1. And so, yeah, this company, there is possible argument there might be some value in this company. Now, one concerning thing here is revenue growth since they listed has been 23.5% per year. That's pretty nice revenue growth, but earnings per share growth has been only 1.92%. So either the margins have been dropping or shares outstanding have been increasing. So that's one little concern, that earnings per share have not really increased over the past 10 years when revenue has. So there is a bit of a disconnect between revenue growth and earnings per share growth. So that's one thing I'd like to look at. Yield 5.4%, and dividend per share growth has been 7% over the past 5 years. There's no 10-year number there. So probably they did not issue, well, probably have 9 years of history of dividend history. Okay, so let's have a look at the P ratio history of this company. This is what drew me in. So what I'll do is go to financials, go to ratios, and we'll go to a P ratio. Okay, so this is the 10-year history, P ratio. So according to this, it's now 20. So maybe there's a little bit of a delay to one of these numbers, either the overview number or this particular number, but it's around 20. We'll just say 20. Now, the P ratio of this company doesn't fall below 20 all that often. So when they listed, the P ratio was about 25. It did fall below 20 back in late 2017, and the low P ratio of this company was in 2018 when it went down to 16.7. But over the past 6 or so years, the lowest P ratio this company has been around about 24 during the COVID-19 financial panic, and it's been as high as about 40 to 45 back in 2022. So the cheapest, 2018. In fact, the exact cheapest was 15.8 on the 5th of March. So let's have a look at the chart. So I'm assuming the 5th of March was when the share price reached its low right here. And that looks probably about right. Yeah, 5th of March 2018, share price was about $3.50. Okay, so just based on P ratio history, this company looks like it could be good value. And the upside could be double where the share price is right now. So there must be a reason why the share price is in a downward trend. Okay, so now what I'm going to do is just have a look at a few other things. Okay, so revenue growth. First thing I always look at is revenue growth. Now, I prefer to look at revenue per share growth. Guru Focus does give us that information, but a lot of the other platforms don't. So let's have a look at revenue growth for this company. So we're just going to get rid of P ratio. So revenue is growing. The other thing I like to look at is shares outstanding. So shares have been increasing. More than likely, one of the reasons why shares have been increasing, in fact, I want that as a line. And where is it? I want that as a line. There we go. Shares have been increasing, and probably one of the main, they've got expected numbers for revenue here. I did not want that, but one of the reasons why probably shares have been increasing, in fact, they've increased by 50% since they listed, is because this company is acquisitive. They're making acquisitions, and that has helped revenue grow. So that has helped revenue grow, but maybe earnings per share haven't grown because of the dilution to shareholders. Now, one of the other reasons why revenue has grown but earnings per share have not is because of margin. So let's have a look at the margin history of this company. This is probably the second thing I look at, and I typically look at gross profit margin, and I might also have a look at operating margins. And the first thing, when I have a look at gross profit margin, margins are shrinking. In fact, before 2019, margins were typically above 70%. Now they're falling towards 60%. So that is not ideal. I prefer to see gross profit margins at least not dropping. So going sideways or rising. Now I just have a quick look at operating margins just to see if it's true for this one as well. And it does look like it's true. Just want to get rid of gross profit margins. And yes, In fact, operating margins is even worse. It's dropped from 42% down to 21% since they listed. So operating margins have halved since this company listed. So that's one of the reasons why earnings per share just has not risen. Share dilution and margins have dropped. And so let's just confirm earnings per share. In fact, earnings per share probably be, we only got like 0.2, 0.2, 0.2. If you have a look at profit or net income, it will have increased. But the main reason, or one of the reasons it has increased, is because this company has been acquisitive. Funnily enough, the estimated or the expected profit in 2025 and 26 have more than doubled from 2024. If they do experience that, that means the P ratio of this company would be really low. Interesting. So just by the way, this is really interesting. So I just mentioned that shares on issue have doubled. And you'll notice the other thing here, income has doubled. So it's gone from $30 million to $60 million. So that's why earnings per share have not increased. Shares on issue have doubled. Profit have doubled. Yeah, there we go. It makes perfect sense when you think about it. Okay, so now based off these metrics I've looked at, decreasing margins, no increase in earnings per share, nice increase in revenue, but you do have to dig a little bit deeper. Just based off that, maybe even though the P ratio is at good levels or interesting levels, I definitely would not consider this company high quality just because of the lack of growth in earnings per share. I want to see persistent revenue per share growth, but also I'd like to see margins not dropping. That's very important. So definitely not a high quality company. So because it's not a high quality company, even looking at this company in terms of whether or not it is good value, I'd probably stay clear. I'm only looking for high quality companies when it comes to my longer term holds. Now, is this a trade? Based off the chart, absolutely not. So at this point in time, I'm staying away from IPH because I don't think it's a trading stock right now. And even though it might be good value, I don't think this is a high quality company. Okay, that's all I have for this look at the stock of the day, IPH. Although if they do achieve these nice growth in revenue or profit, which could be because of acquisitions, by the way, maybe this company could be considered really cheap. Anyway, if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.